Hi everyone, Nick here, welcome back. What if I told you there was a way for a married couple to earn up to $109,250 per year from investments and pay $0 in tax? It sounds too good to be true, but it's not. It requires planning and an understanding of the tax code. In this video, I'm going to show you how this is possible. We're going to cover the basics of taxes on investment income. We're also going to look at how your withdrawal strategy may change in different stages of retirement. This is another episode in my series on retirement planning. I'll put a link to a playlist below with other videos. Remember that taxes are complex. I've done my best to make sure this information is accurate, but I am not a tax professional. You should do your own research and possibly work with a professional. First, let's look at the different types of income sources we could have. The simplest way to look at this is based on the type of account in which you hold your investments. We have three main categories: tax-deferred, tax-exempt, and taxable. Tax-deferred means you get to avoid paying income taxes on money you contribute to the account. You don't have to pay annual taxes on growth within the account, but you must pay taxes when you withdraw from the account. The most common tax-deferred accounts are traditional 401k or 403b, and traditional IRAs or simple IRAs. Tax-exempt is where you don't get any tax benefit when contributing, but the money grows tax-free and you can withdraw tax-free. The most common of these are Roth 401ks and Roth IRAs. The HSA is a special type of account that is tax-free for medical expenses, but can be used like a tax-deferred account for non-medical expenses in retirement. Both tax-deferred and tax-free accounts are called tax-advantaged accounts, since they come with various tax advantages. Clever. These are types of accounts that have restrictions on who can contribute to them, how much you can contribute, and at which age you are allowed to withdraw without penalty. Finally, we have a normal taxable account that doesn't get any special tax treatment. I believe it's a good idea to diversify your investments across these types of accounts to take advantage of the tax benefits and get extra flexibility. Next, let's look at how these types of accounts and investments translate into actual income and taxes. There are three main types of income for tax purposes. First is ordinary income, which includes income from wages, interest from money market accounts or bonds, non-qualified dividends, short-term capital gains, taxable Social Security income, distributions from tax-deferred retirement accounts, real estate rents, and most REIT dividends. There are definitely more types of income that fall into this category, but these are the most common. Next, we have long-term capital gains and qualified dividends. If you hold stocks for more than a year, your gain on the price appreciation is treated as a long-term capital gain. If your stock pays a dividend and it's qualified, it also falls into this category. Qualified dividends have to meet specific criteria set by the IRS. Finally, we have exempt income, which isn't taxed at all. Probably the best kind of income. Now, let's match the investment account types to these tax buckets. The simplest are the tax-exempt accounts. No taxes are paid if you follow the rules of when you are allowed to withdraw. The next simplest are the tax-deferred accounts, where the entire distribution is taxed like ordinary income. Next is Social Security. A percentage of your Social Security benefits are taxed, and it's based on your total income. It could be anywhere from 0% up to a maximum of 85%. The taxable portion is treated like ordinary income. Finally, the complexity comes from taxable accounts. Part of taxable account income could qualify for the lower long-term capital gain and qualified dividend tax rates. The remainder is taxed like ordinary income. Now we understand the major investment accounts and types of taxation. Next, let's look at more details of the tax rates. First, let's look at the tax brackets for ordinary income. We'll look at a married couple filing jointly in our examples for the year 2022. The US uses a progressive tax system, meaning the first $20,550 this couple earns would be taxed at 10%. The next $63,000 would be taxed at 12%. Then the next $94,600 would be taxed at 22%. And so on, up to the highest tax rate of 37% for income over $647,850. A common misconception is that going up a tax bracket means it applies to all of your income, but it only applies to each dollar you earn in that bracket. Now let's compare this to the dividend taxes and long-term capital gains taxes. I'm just going to call these dividend taxes, since it's easier to say than long-term capital gains and dividend taxes. If your taxable income is below $83,350, your dividend tax rate is 0%. Once your taxable income goes over this amount, dividends are taxed at 15%, up to a taxable income of $517,200. If your income goes above this, the dividend tax rate is 20%. Remember, most corporations pay taxes on their profits before they distribute dividends to shareholders, so dividends are effectively taxed twice, which is probably why the rate is lower. If all your income were from qualified dividends, it would be progressive, similar to ordinary income. If you have both dividend and ordinary income, it gets more complicated to calculate since both are calculated based on your total income instead of just that type of income. Now we have covered the fundamentals of different types of tax-advantaged accounts, different types of income, and different tax rates. Let's look at how a married couple can take advantage of this to earn that $109,250 of income with $0 in tax. The breakdown would look like this. You receive $83,350 in qualified dividends or long-term capital gains, which are taxed at 0%. In addition to this, a married couple filing jointly gets a $25,900 standard deduction. Your taxable income is reduced by this amount, so you can take an additional $25,900 at 0% tax. It would be optimal to use this deduction for ordinary income, since ordinary income is taxed higher. One great thing you could do, even if you don't need the income, is convert a traditional 401k or IRA to a Roth. This strategy works best for early retirees. Let's look at exactly how it could work. When I run these numbers, I use software like FreeTax USA to simulate an actual return. This allows me to look at the actual forms and worksheets so I can understand how the different numbers factor into the equation. The software is currently only available for 2021, so this example will be for 2021, which is a little lower than the 2022 example since the tax brackets and standard deduction have been adjusted for inflation. Here's what I will enter into the software: $0 for Social Security, $2,000 interest from bonds or money market account, $500 in unqualified dividends, $22,600 retirement account distribution, which may be a Roth conversion, $10,000 in qualified dividends, and $70,800 in long-term capital gains. This brings us to exactly the maximum we can get in the 0% dividend tax bracket and the standard deduction in 2021. In the tax software, we can look at the sample 1040. In this example, we can see an adjusted gross income of $105,900, a taxable income of $80,800, and $0 in tax. You could also look at the qualified dividend and capital gains tax worksheet, which looks like this. It's a bit convoluted. You could see exactly how the calculations work if you want. In this example, the $80,800 in qualified dividends and long-term capital gains are not taxed. This is mostly applicable to an early retiree or someone that is at retirement age but not yet taking Social Security. For many retirees, it's a good idea to defer Social Security until age 70, but that's a topic for another video. Now, we've looked at how to simulate this with tax software. Let's go back to the spreadsheet and take a look at some other scenarios. As you progress through retirement, you may want to change your income strategy. It will also depend on how much you've saved in your various account types. You might want to take more distributions from the traditional account if you're at retirement age waiting for Social Security, or if you just want to convert more to the Roth and plan to spend money from a Roth account instead, maybe with a Roth ladder. We'll use the same scenario as before, but add $10,000 to the traditional distribution. The tax owed would be $1,003. This is roughly 10% tax on that extra $10,000 distribution, which is probably as good or better than if you let the money continue to grow tax deferred and pay taxes later. We could continue to add more. In the next example, instead of taking any capital gains, we'll take a tax deferred distribution of $93,650. In this case, you end up paying $8,169 in tax on that distribution, which is roughly 10% of the $81,050 in taxable income. So you can either take the capital gains from the taxable account at 0% or a tax-deferred distribution at 10%. Now let's look at an example of a couple taking Social Security. Let's say the couple gets $50,000 per year from Social Security, $2,000 in interest, $10,500 in dividends, with $500 being non-qualified, and takes $51,150 distribution from a tax-deferred account. In this example, the tax is the same as in the last one, with $8,169 in tax. You can also use the tax software to see the Social Security worksheet that shows how much of your Social Security income is taxable. Now we have an idea of how to simulate different tax withdrawal strategies and compare them. I think it's very important to plan ahead and think about how you will take your income from your portfolio in retirement. It will likely change during your retirement. If you retire early, defer Social Security, or once you hit age 71, the IRS forces you to take required minimum distributions from your tax-deferred accounts. If you have investments in these different account types, you will have different levers to pull to control how much you're paying in taxes. You really want to shift as many assets from the higher tax sources to the lower tax sources while paying as little tax as possible. It can be difficult to calculate, but estimating this and considering how you will pay taxes in retirement is worthwhile. My current plan is to try to use my early retirement to convert as much as possible from the traditional to Roth at the 10% tax rate, while living off qualified dividends and capital gains from taxable accounts. Hopefully, by the time I take Social Security, I'll have converted most of the tax deferred to Roth. I want to build the Roth for the tax-free compounding. This way I'll have a really large Roth by age 70 and possibly pay no tax on my income if it's just Roth and Social Security. Of course, the tax code is likely to change over the years, so we can't get it down to an exact science. The plan may have to adapt. Let me know in the comments below how you plan to minimize taxes in retirement. If you got value from this video, make sure to press the like button and share my channel with your friends. Thanks for watching. Later.